The COVID-19 pandemic has affected all small businesses in the U.S. Virgin Islands, but there is help to move your business forward. The Virgin Islands Small Business Development Center is available to assist entrepreneurs and small businesses. The VISBDC is the territory's #1 resource for small businesses and is sustained by the University of the Virgin Islands and the U.S. Small Business Administration. The VISBDC is nationally accredited and provides one-on-one advising, business education training, and technical assistance at no cost. Attend workshops by experts from both the public and private sectors. From idea generation to exit strategies, the staff at the VISBDC are ready to assist you. So don't wait. Call, email, or visit them on the web at www.visbdc.org and Facebook, or simply download their mobile app on the Apple or Google Play Store. Just search VISBDC. Discover how they can help your business grow and succeed.
Welcome. An intro to the VISBDC Tuesday with SBA. We have collaborated to bring you this series of webinars to help USVI small business owners further connect and benefit from the SBA PR and USVI district office for what they have to offer. This is just a friendly reminder for you to put your questions in the chat, and they will be answered by the presenting team, either in the chat or later during the question and answer segment. A copy of the presentation is available upon email request to info@visbdc.org. We encourage you to take a few minutes after this training to fill out the survey that will let us know how we are doing. Senior Area Manager Wayne Huddleston, the floor is yours.
Thank you, Mary Jo. I appreciate it. And thank you to the SBDC for hosting. This is a continuation of our regular Tuesday, I think every other Tuesday webinars now, where SBDC will host SBA to talk about a particular topic. Today, it will be about the 5 C's of lending, or more, another way to put it is how to secure a loan with a conventional lender. So as in other times when we've had these webinars, I will present on a topic. It will only take probably 25-30 minutes, and we'll leave plenty of time at the end to answer any questions you have about the topic today or about anything related to SBA. We have plenty of time to discuss it. So if you have any questions along the way, feel free. I think there's an opportunity that you can put them into chat. And we'll be sure to answer them at the end. And then at the end, I think people can come off mute as well. So we're going to go ahead and get through today's presentation. Here's what we're going to cover. We're going to talk about different sources of capital where you can use to either start or grow your business. But then we are going to focus on lending. So we're going to start with the 5 C's of credit, which is a general framework that lenders use to assess whether a deal is worthy of providing a loan to. And all these lenders assess these 5 C's differently, but they all do assess the 5 C's. So as a borrower, you should be familiar with them. Then we're going to talk about government guaranteed lending and SBA's role in the lending process. Then we're talking about technical service available. And then, as I mentioned, there'll be plenty of time at the end to answer questions. Now, hopefully this will work and the volume will work for you. This is a little video. It's on YouTube. It's about 2 or 3 minutes or so, but it's a good introductory video that talks about the sources of capital and where business owners are most likely to find capital for starting or growing their business.
Most young companies need money, which may or may not come as a big surprise, but they do. The #1 source they get money from is from their own savings, whether it's a few $100s or even thousands of dollars. That's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings. And then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital. And the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation, because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And young companies don't have any security. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you want as a startup as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kaufman research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them. It's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms, because venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that have become complacent. And interestingly, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or a $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, Bob's your uncle. Run. Keep all the equity, because there's no better thing than being in full control of your own destiny.
All right. Well, that was a good introduction to just the sources of capital. And in that video, you'll notice that a lot of things were mentioned, but a key takeaway from that is that most people, especially when they're starting a business or they're very early, are getting their money either from savings or cash flow from them being able to start their business, or credit cards or other areas other than a bank. I know we're going to focus on banks here, but banks oftentimes get, as it said in the video, a lot of attention for providing funding to businesses, but really that's a very small, the reality is that business or banks provide a very small amount of capital for businesses. This is another chart that kind of emphasizes that point. Startups get, and this is focusing on startups, not necessarily established businesses, but as a business that is starting up and very young, the vast majority come from personal savings and credit or friends and family. And then smaller amounts will come from an investor or bank financing or crowdfunding or something similar to that. But just a little over 1% is actual bank financing. Now that expands significantly for businesses that have been in business a while, but for startups, it's a very small amount. Most of them will get through the beginning stages and the early stages of a business by bootstrapping. And even many established businesses will use bootstrapping as a way to grow and get their business without having to go to external people or banks or institutions for funding. And that's merely a way of trying to be very creative, renting instead of buying, or borrowing some equipment if you need it from another person to get by, and then get some revenue to get the purchases you need ahead of time. But all sorts of ways that people can and businesses can be creative about how they find money and how they secure money instead of just going to someone else and saying, I need that money up front to start my business. Can be considered bootstrapping. And it's the most common source of funding for businesses. But today we are going to talk about the 5 C's of commercial lending. We're going to focus on lending from a bank or a lending institution. Sometimes there are some differences between banks and lending institutions. There are, hold on a second.
I'm sorry, I'll call you right back.
Thank you. Sorry, I was trying to hang up on a phone and it answered it for me. So 5 C's of commercial lending. So yeah, it's a general, as I mentioned, it's a general framework that all institutions are going to use. They're going to vary on how they view the 5 C's. Each institution will have a different risk tolerance for different industries, different locations, whether people are startups or been in business for a while. Those are typically developed over time and are largely influenced by the experience the bank has had in certain industries, and whether those loans have been paid back effectively or not, and how they feel comfortable about those areas. But they're all going to be looking at the 5 C's. They're just going to look at it a little bit differently, but we're going to go through each one to make sure you have a good understanding of what they're going to be looking at as they evaluate a deal that you may be going to them with. So the first one is capacity, and that is simply the ability of a business to repay a debt. And that is the overall, when a lender looks at a business, they just want to know, if I give them this loan and there's going to be monthly payments on this, do they have the capacity to pay that loan? Or am I just guessing on that? So the major thing, the primary thing that all lenders are going to look at to determine capacity is to see if the business generates sufficient cash flows. And what they're most going to look at is the existing financial statements that show over the past 2 years, 3 years, maybe even a little bit more, as to whether that business has over time shown that, yes, it does bring in the revenue and it does bring in sufficient revenue to meet its current obligations, plus the additional obligation I'm about to throw on it with a loan. On some situations, lenders will use projected cash flows, but most lenders are very hesitant to do that, and many just won't do it at all. Many will just say, if it's going to be a loan for a startup business, we're just not going to be able to do it. Now, if you show us that you've been in business for 2 or 3 years, and then come back and talk to us, and then we may be able to provide you a loan, but we need to see those financial statements. I know that's very frustrating for many startup businesses because they're almost in this no-win situation where they need some money up front to start their business and get it going, and then they can show the cash flows and the financial statements that show they can be profitable. But then the lender says, we can't give you a loan until you show that you're profitable and are in business. So that's why most businesses start off with bootstrapping or cash or something else. Another part of this capacity, in addition to the financial statements, is your credit score. And that will vary by lender. It will also vary with time for each lender. So a lot of people say, well, just what is my credit score? Now, it's a lot more than just your credit score that determine whether you are able to secure a loan. And that credit score will vary. But in general, I strongly recommend that you have a credit score above at least 650 to be within consideration. If you get below 650, many lenders just aren't really interested in talking to you. Businesses are already risky ventures for many lenders. And if the credit score also shows a history of not paying obligations effectively, then that just makes it less likely. So 650 is not by any means a magic number. The higher, the better. If you can be over 700, that's even much better. But 650, you want to shoot as a minimum. You don't want to walk into a lender with less than a 650 score and expect to get a positive response from them on a loan. The next C that they're going to be looking at is capital. They're going to want to see how much money you have personally invested in this venture. No lender is comfortable 100% funding your venture. They want to see that you have some skin in the game, that you've paid enough attention to this to have some savings, to buy some equipment yourself, to put a risk in it yourself, so that if this business fails, it's not just the bank that's on the hook, but it's also you as well. So they want to make sure that you're involved in this with some funds. They're going to see how much you're putting in. So if you're looking at a business deal, let's say you're trying to get a loan, and part of this loan for your business is to secure a piece of property. Well, if that property is $50,000, they're going to know how much you're putting in the deal. Are you putting in, just like in a mortgage deal, are you putting in 10%, 20%, 30%? What is it? How much can you put in? The more you can put in, the higher likelihood you will have resolved this C for a lender. So 20% is typically a minimum of what they want to see. You sometimes can get away with less, but 20% is a minimum. And certainly if you can do 40, 50%, that's even much better to a lender. They feel a little bit more comfortable giving you the rest of those funds that you need to secure the deal. The other C that they're going to look at is your collateral. And these are going to be assets that can be pledged as security for the loan. And think of this more as a secondary source of payment. Many businesses fail. Of course, startups have a high failure rate within the first 3 years. If a business can get beyond that period, there's still a riskiness and likelihood that they can fail. And really anything can happen out of left field. Months before COVID, no one ever thought that that was going to happen and the whole economy would be shut down and impact the tourism industry. But that happened, and that came out of left field. So there are all sorts of things that can happen that can make a business fail or make it unable to repay the lender on its note. So if it does, a lender wants to have some sort of security. So if they are providing you a loan, it certainly helps to have a physical asset that can be secured against that. So this is where loans for real estate and buildings are a little bit easier to come by, because then they can serve as that source of repayment, so that there can be the lien holder on that building or that piece of equipment. And if the business fails, or you just walk away and decide to stop paying them, then they have the legal right to secure that property or equipment from you, sell it on their own, and then recoup their losses. Now, a lender does not want to do that. They do not want to be in your line of business. They do not want to be selling assets. They do not want to go through the liquidation process. They just want to give you a loan, and you repay the loan, and they make a little tiny bit of interest on it. But this is certainly, it helps a lender in that process and their decision-making process if you can secure some sort of collateral. Typically, if you're the type of business that sells a product, your product is typically not good collateral for a lender. So if you're selling if you're baking items or food or things like that, or making some sort of item for that you resale, they typically won't use your inventory, but they will use your equipment if it's normal equipment that's not specialized. Then they're going to be looking at conditions of the market. This is what is going on in the overall economy, in the local economy where that business is going to be working. Is this business operating in an industry that is growing, or is it one that is contracting and not doing well? Is there a reasonable chance that the growth projections for this business that have been displayed in the business plan are reasonable? Do they make sense? Do they take into account what competitors are in this business? If there are suppliers, what those are, what the customer relationships are. They really want to see that you've assessed these risks and are prepared to mitigate against them. The conditions are largely addressed in your business plan, but also your interaction face-to-face with the lender. They'll ask you a lot of questions to make sure you're thinking about your business, that you understand your industry specifically, that you know how to overcome any challenges that may come up, and that you know how to make money in this business. So they want to see you be successful, because when you're successful, you can pay back their loan. So they want to see that communicated either face-to-face, but also especially in your business plan. It's going to be an important part to put in there. Then finally, they're going to assess your character. And this is a little bit, it's not as always clear as some of these other 5Cs. So for instance, you can improve your credit score, and that's a clear number. You can have collateral, and that is a very clear substantive thing that says, this is my collateral, or this is my cash that I'm putting in a deal, or these are the conditions. Your character is not necessarily, you can't just write on a piece of paper and say, I'm a good person with integrity and answer that. This is really assessed over time. And it starts from the moment that you speak with a lender. So for instance, if you set appointments with a lender, do you show up for them? If you can't make it and something comes up, did you notify them ahead of time? If you said you were going to provide financial statements, did you provide those financial statements? Are you truthful when you talk about your business or your past or anything that you have? Are all your statements truthful? Do you have a good reputation in the community, or have you had some other legal troubles in the past? Now, legal troubles won't necessarily prevent you from getting a loan, but certainly trying to disguise them or hide them and not be honest about them can. It is assessed at every interaction that you have with a lender, from your verbal meetings to your written, to what you're doing in a community. And oftentimes it's just a subjective and gut feeling. I have had lenders talk to me in the past and have had deals where they were on paper, it looked a little bit risky and something that a lender could easily walk away from. But after a few meetings with the prospective borrower, I've had lenders tell me before, I just have a gut feeling. This guy is really honest. He seems to really know what he's talking about. I believe him. I think I'd like to try a way to make this deal work. I've also seen on the other side too, where businesses have looked fantastic on paper, have a great credit score, have collateral for their loan, have good financial statements, and have other things, but then they either were not completely honest about something, or tried to hide some legal proceedings in their background or something else, and that can completely sink a deal. No matter how good it looks on paper, if a lender assesses that your character is not worthy of providing a loan to, then they will just, that will sink your deal. Now, to increase your chances of securing a loan, of course, you should know the 5Cs. And I highly suggest that if you are about to walk into a lender and discuss securing a business loan, I would, before you walk into that lender, sit down with a pad of paper, write the 5Cs on a sheet of paper, and discuss or write down and assess how you are addressing each of those 5Cs. You want to address, first, you want to know what your credit score is. You want to be able to clearly say, this is how much cash I've put into this project, or I am putting into this project. This is the collateral I have. These are my financial statements, business plan, all sorts of things. However, in our interactions with lenders, both locally and across the country, one of the number one struggles that business lenders have is securing proper financial statements, a proper expense sheet, proper balance sheet, cash flow statement, income statement, and reasonable financial projections. I highly encourage you, if you have not been keeping up with these financial statements, that you enlist the help of an accountant or look online. There's plenty of resources out there. There are resources such as QuickBooks and others that can help you develop these. But this is a real struggle for business relationship managers. So here, especially in the Virgin Islands, especially when you're talking about the big three banks of Popular, First Bank, and Oriental, be aware that the underwriters, the people who actually make the decision on those loans, are typically not here in the Virgin Islands, and they're typically not the people that you're going to be meeting with face to face. So what you want to do is you want to view your local business banker as your advocate. And so you want to give that advocate as much information as you can and as much tools as you can to present to those underwriters and say, this is a worthy investment for our bank. So you want to have good financial statements. So we're going to talk a little bit about what those are and the three important ones that you're going to need. You're going to need a balance sheet. And this is basically a snapshot of at any particular time. So it can be as of today, or it could be a balance sheet as of last month, but it is what are the assets and claims against those assets at a particular time and how it's financed. So this gives a lender an understanding of how much collateral you have, how much cash you have on hand should a loan go bad, and what your financial position is as a company. Your income statement shows revenue and expenses and your profitability over a specified period. This could be an annual income statement. Typically, these are also done quarterly. They can even be done monthly. But it'll show, okay, over this 90-day period, this is the costs that we had during that period and the outflow of our revenue. And this is the revenue that we had in, the income that we took in. And then you can compare those two and show, is there profitability there, or is the business losing money? And then the cash flow statement shows the sources and uses of cash, as well as cash and change in cash over a specific period. So we're going to look at what those look like. So this is a sample of a very simplified balance sheet. So typically you will have how much cash you have on hand. A lot of small businesses in the Virgin Islands, you're not going to have securities, but you should certainly probably have accounts receivable and some sort of inventory, depending on the type of business and industry you're in. So this would be your assets. Then you could have long-term assets such as a building or large equipment that is typically depreciated over time. You may have land, you may have a vehicle, you may have those types of things that would be considered your assets, and those depreciate. So with each following balance sheet, those are typically depreciated just a little bit more. For instance, if you had a vehicle that's part of your business, on that first year of business and the first year of the vehicle, it's pretty high in value, but 5 years later, it's not going to be worth as much. And certainly 10 years later, it may be close to zero. And then you're going to have a list of your claims on your assets. If you have a loan already, you're going to have that here as notes payable. If you owe money to suppliers or others, those would be other liabilities. Then you'll have that over time and show that on your balance sheet. This would be an example of again, these are very basic examples. This would be an income statement over a period of time. So as I mentioned, it could be 3 months, it could be longer, it could be shorter, but you want to show what are the sales during this period, what the costs of your sales have been, or the cost of your goods for the sales, and then it'll show what your profit is. And then you'll show other administrative expenses. If you have administrative expenses, if you have other income from operations, or other interest expenses on your loans or something like that, you'll put that all in there, and then you'll show your income before taxes and income taxes, and then your net income. So this will show your net income, and your net is your income after the cost of goods sold and other liabilities that you have. That will show what you have. So you want this bottom number here to be as high as possible if you're trying to secure a loan, to show that I have enough income to not only operate the business and pay the liabilities on a business, but also pay myself and have the income I need to enjoy, but also, again, pay a loan on top of that. So they want to see that number as high as possible to give you and them as much comfort and much room for flexibility. You don't have a cash flow statement, operating expenses, depreciation, as I mentioned earlier, changes in accounts receivable, changes in inventory. Your financing activities, you're probably not going to be issuing stock as a small business, but you could. And so it could be here, this is just an example, but borrowings, your net increase in your cash at the beginning of the period, cash at the end. And these are all statements that an accountant can draft for you, or you can learn to do yourself and have done through QuickBooks or other formats to produce these for a lender. So as you go forward, the next part I want to talk about is SBA's role in the lending process. So SBA does not provide a loan directly to a business, except for in cases of disaster. Now, things have been a little bit unusual the past few years, with not only we've had Irma and Maria that came through in 17, and then in 20, we were hit with COVID. And so there's been a lot of disaster loans available to businesses and individuals throughout the years recently. However, in normal circumstances, unless it's specifically addressing a disaster, SBA is not going to provide you a loan directly. What we do is we just leverage the federal government's good credit rating. We offer that to banks, and we simply say we will assume 50 to 90% of the risk in this loan, depending on the type of loan. If that allows you to reduce the risk enough for you to provide a loan to a borrower who may not have been either eligible for that loan or eligible for the loan under favorable interest rates. You can think of it this way. Out of 10 people walking in to get a loan from a business, typically 8 of those 10 are just not going to be bankable in any way whatsoever, even with a guarantee from SBA, either because they're a startup and that particular lender is not comfortable providing a loan to startup without several years of financial statements, or perhaps the credit score is low, or there's insufficient collateral, or not enough cash, or something. So typically around 8 of 10 would just not be bankable. One of those 10 may come in the door, and it may be an established business, has good cash flow, has good cash on hand, has good collateral, and is essentially just needing a little bit of financing to execute on some deal that they have going on, but they're very credit worthy, and lenders are falling over themselves to give loans to those people. You know, the old joke is that lenders will give loans to people who don't need it, but the people who do need it, they will not want to give loans to. But every once in a while, those people come in, or those businesses come in the door for a lender, and they match all their 5c's, and they can provide that loan and get it done. And then you'll have one other person who may come in and may be a business that has been around for a short period, has some financial statements, can show some reasonable cash flow, but perhaps they just don't have sufficient collateral, or maybe they have sufficient collateral, but they just don't have enough cash in the deal, or maybe they've been in business 2 years, but the bank is really comfortable with 3 years, so they're close. So it's not quite ready and not quite bankable under normal circumstances for a lender. That's where our SBA guarantee would come in. That's where the lender can go to SBA, say, yes, we would like you to assume risk in this loan. That will allow us a little bit more comfort level, and we can go ahead and provide this loan to the borrower at a reasonable rate. We have caps. If a lender is going to be using our guarantee, we do have some stipulations that they have in there. There have to be caps on how much their interest rates are going to be, their terms. It can't be predatory lending or large balloon payments at the end that are impossible to make. So that's where SBA comes in. All of the lenders in the Virgin Islands, all the major lenders, I should say, in the Virgin Islands are eligible to use the SBA guarantee and have in some way or another. So Popular, First Bank, Oriental, Merchants Bank, Bank of St. Croix are all authorized SBA lenders. All of them are familiar with SBA's lending process. All of these participated in the PPP program, the Paycheck Protection Program, that was as a result of the pandemic. And all are authorized to do what we call 7A loans, which are loans that cover a variety of different guarantees that SBA can provide to reduce their risk in a loan and get a deal done for you. So advantages of the guaranteed loan program, primarily, as I mentioned, it just makes it less risky for them. So it doesn't take all the risk. We do not typically take 100% of the risk out of a loan. We want a lender to do reasonable underwriting the loan and reasonable assessment on that it's going to get paid back, because this is the public's money. We don't want to just throw that out there and have it blown on some loan deals that aren't really done right. So this is a guarantee where we're offering that guarantee, and we want the lender to do its proper due diligence. But when we offer that guarantee, it reduces that risk for them, and it makes it easier for them to get a loan done. For you as a borrower, how does that help? With our stipulations and using the guarantee, you can possibly do it without as large of a down payment or as much collateral on hand. You can get reasonable interest rates at sometimes longer terms than what a bank can offer otherwise. There are no balloon payments or demand clauses. Now, it's really up to the lender on how they use that, because each deal that walks in the door is different. Some prospective deal may have sufficient collateral. Some may have sufficient cash. So it just depends. So they will typically decide how to use that guarantee for your benefit, but it can be very beneficial for you. Now, I will say that a guarantee, typically, if you have multiple challenges in meeting the 5Cs, for instance, if you're not only a startup, but then you also don't have any cash on hand, or you also don't have any collateral to secure, your chances of getting a loan are very, very low, and a SBA guarantee is not going to be able to overcome that. But they'll use this guarantee to address typically one of those 5C areas that can help get it across the line. So SBA-backed loans can be used for a large variety of purposes to launch and grow or start up a business. Now, a lender may not wish to use the guarantee for a startup. If they are just uncomfortable with startups, it's their prerogative. They can say, regardless of a guarantee, we're just not going to provide loans to startups, and that's fine for them. But many businesses, many lenders will say, yes, we understand startups are risky, but with that guarantee, that allows us some ability to do a startup. So there are cases where they can do it. You can do it to purchase a business that's already existing. A more creative way sometimes is just to access a revolving line of credit. Instead of getting cash lump sum upfront from a bank, sometimes bank will say, well, we're not comfortable with that, but we can extend you a line of credit that is secured by an SBA guarantee. It can be used to purchase and renovate facilities, purchase inventory, purchase land or real estate, or in the exporting process of a product or service. It can be used in a lot of different ways. It's very flexible. Now, there are resource partners that you should be using before you walk into a bank. Highly suggest that you don't walk into a bank blind. While we're giving a lot of good information here and you can prepare yourself, it's always beneficial to get the help of some counselors or some business advisors who have experience, who also, in many cases, know the individual lenders, especially locally in their market, and will know what they're looking for and can sit down with you and put another set of eyes on a loan package. And so they can say, okay, the lender's going to be looking for this kind of collateral or this kind of cash flow in your business. Let's take a look at what you have. Let's look at your financial statements to make sure it's what they're looking for. All of these services are free of charge. There's the Small Business Development Center, of course, which is our host today. There's SCORE, and there's VBOC, which is a Veterans Business Outreach Center. They operate, they don't have a person here locally, but they can meet with you virtually, provide some counseling. All three of these entities also collaborate with one another, and they share their resources. For instance, SCORE has a lot of fantastic templates on their website, sample business plans, sample financial statements, sample projections, other things that you can use and download free of charge to help develop your case to secure a loan or develop your business plan and think through your ideas. SCORE also offers mentors and coaches, operate a little bit differently than the business consultants that you'll get at the SBDC. More of typically matching you with someone who maybe is either experienced in your industry or familiar with your industry or your particular market, who can sit down with you, bounce off ideas, share their expertise and challenges that they may have seen in the past, and help you through situations. SBDC, though, is probably one of the most adept at helping businesses through the process of securing a loan. They can help you with all sorts of aspects of your business, assessing the health and feasibility, guide you through development of a sound business plan. They can provide some market and industry research that you would normally have to pay a significant amount of money for. They can access that for free and can help you with that. They can review your financial statements. They can help you with your loan application and actually introduce you to lenders that they know have been able to provide loans in your particular industry. They can connect you with government agencies if you're going into government contracting, and they can help you develop expertise in your business management. One of the best things I think an SBDC advisor can do is can give you the unvarnished assessment and truth about how they see your business. These are business advisors that have a lot of experience working with many different types of businesses and many different types of business owners. They also have regular annual training. They coordinate with business advisors, not only on their team, but around the country. They have seen a lot. And so they can help you avoid mistakes before you go down the road. I used to be director of a business, small business development center in years past. And I would tell my team, one of the best things we can do sometimes is talk people out of bad ideas before they throw money at something. There are a lot of people who will save up over time, will work for someone else, and then they'll maybe retire early and they'll have their nest egg and they'll want to put that into starting a business. And this is, nest eggs are really important for people if they want to retire and have a comfortable life going on. If that business can make sense, then we should do everything we can to help them along the way. But if there are serious red flags, it is our responsibility as advisors to give them the truth and ask the tough questions that perhaps their friends and family members are not willing to ask or challenge that person on. So they can help a lot. I always encourage you just to sit down, make an appointment, talk about things with them before you talk to a lender, or just check in every once in a while and see what their assessment is of your business. There are also additional resources. If you haven't signed up for our updates, you can get them directly from us, sba.gov/updates. You can also follow us on Twitter. We often tweet out when we're having workshops or webinars or important information that's being provided by SBA. You can email us directly. Our office number is there, but I highly encourage you to email us, as that is the best way for us to respond to you. Oftentimes, if you're calling, I'm not able to answer. The voicemail here, as you know, sometimes Liberty can be a little bit slow in getting the voicemail to you. It's always best just to send us an email. You can email me directly at that email address, or my colleague Lisa, who is also online with us today. And then finally, there are some resources that you can use online and just review on your own time. We have a Learning Center dashboard at sba.gov that covers all sorts of topics on starting and growing your business or getting into government contracting or other areas. We have another platform specifically developed for women-owned businesses. It was developed a little over a year ago called Ascent. A lot of fantastic resources there on Ascent that you can go through at your own time and at your own pace and learn a lot. And then there are COVID resources. We'll probably start taking that link out here before long. We still have some COVID resources available, but those are dwindling down as we get to a new normal of living with COVID every day. So that's it for my presentation. As I mentioned, I want to leave a little bit of time. Looks like we got between 15 and 20 minutes here to answer any questions you may have. So I'll stop talking.
Thank you, Wayne, for that very informative presentation. While we wait for people to put their questions in the chat, or if they have a question, they can raise their hand if they want to go in on air. I'll go ahead and give an update of what's coming up. Now, the SBDC has so much more in store for the USVI small business community. Visit our website at www.visbdc.org. Download the VISBDC app on your mobile device from the appropriate app store. Like and follow us on Facebook, Instagram, Twitter, Google My Business, and subscribe to the VISBDC YouTube channel for new uploads of our webinars on demand. Now, our upcoming seminars, the one that was originally scheduled for this evening has been postponed because of things beyond our control. So that's going to be rescheduled for April the 19th at 6 p.m. And that's use a 6-month budget to guide your business recovery. On April the 12th, that's on April the 19th, there at 11 a.m. with Oriental Bank, business concepts, strategies, and best practices. On the 21st at 11 a.m., business development series, starting your business in the USVI. And on the 26th at 11 a.m., we'll have the SBA back with the 504 and 7A SBA guaranteed loan programs. So does anyone have a question that would like to answer on air or put something in the chat? Wayne, it looks like you had a very comprehensive webinar, and it doesn't seem as if there's any questions. So I guess they'll email you if they have specific questions. Again, if anyone wants a copy of the slide deck, you can send us an email at info@bispdc.org, and we will forward that to you. Please remember to complete the survey that'll be sent out to you shortly. And Wayne, we want to thank you for your presentation, and we want to thank all of you for attending today's webinar on the 5 C's of credit. Thank you all very much, and do have a wonderful day.
Thank you.